Okay, in this video we're going to focus on the second of the key financial ratios, and that is the gearing ratio, or the ratio of a business's total debt to its equity. And that really means how solvent is this business? How well is this business going to be able to meet its long-term liabilities? And this really is an analysis of the business's risk, because over the long term, if the business can't meet those liabilities, then it is clearly at a relatively high risk, and there's a risk that that business will not be able to continue to operate. And it's another way to look at it, I guess, is it's an indication of stability or long-term stability of the business. Okay, so what actually is the ratio? So we're looking at total debt to equity. So basically, current liabilities and non-current liabilities divided by the owner's equity, so owner's contribution to the business plus retained earnings, times 100. Note with the solvency or gearing ratio, while it's called a ratio, it is always expressed as a percentage, and that's why it's times 100. So liabilities divided by owner's equity times 100. For this ratio, the higher the ratio, the higher the proportion of these businesses' assets that have been financed by lenders, and the less amount are being funded by shareholders, i.e. equity. So there is a greater reliance on credit or on borrowed funds from the banks. So a business which is considered to have highly geared or a high gearing ratio, that means that they have taken the option to borrow more of their capital than access capital from shareholders. So if you think right back to earlier on the finance topic when we were looking at debt versus equity, a business that is highly geared has taken the decision of gearing. Think about Wesfarmers and how highly geared they must have been when they purchased Coles, given they borrowed about $18 billion to undertake that transaction. So they made the decision to borrow rather than access more owner's equity, and that meant that their gearing ratio went up significantly. And it's thought that a business which relies too heavily on borrowed funds is highly geared, but it's also at high risk, because it's going to need to meet those long-term repayments on that debt, and it may well struggle in the long term. So here's an example. This is from our I Wish Toys financial statements, and you can see here that they have a gearing ratio of 153%. So how's that determined? Well, their total liabilities here are $546,800, which is their $44,000 of current liabilities, plus their non-current liabilities of $502,800. Give them total liabilities of $546,800, and when you divide that by their total equity of $358,200, we can work out that their gearing ratio is 153%. So that would put this business into the relatively high risk category, because they have much more liabilities owing to external parties than they have internal funds from in the form of an owner's contribution and retained profits, and therefore, while they have made the decision to borrow more than access shareholders for equity, this is placing that business at a relatively, and I say relatively because you don't know what industry this business is operating in, what its competitors are like, and also the cost of their debt, but relatively we can make an assumption that this business is relatively highly geared, and it is facing some level of risk, and solvency in the long term might be in question. Now, in terms of solvency, we've kind of spoken about it before, but if a business becomes insolvent, it will be shut down by the courts, and that's to protect future creditors from any loss of money or investment. So anyone else who might look to lend to that business, or businesses that are already lending to that business, it's trying to protect them to ensure they don't incur any losses or any more losses than they already might have. The ratio provides analysis of the percentage of total funds taken up by debt and equity. So what's the comparison between the two? And like I said before, for those businesses that use a lot of debt, they're hoping that that debt finance will bring in higher profits than the interest charged on the debt. So if they're paying 5% interest per annum, they're hoping that by borrowing that capital, they'll be able to increase the overall returns to the business by an amount greater than that cost of interest. The rule of thumb really is around the 100% mark. A gearing ratio of less than 100% is indicating that the business has low risk, and it's lowly geared, and it has high solvency and stability. And conversely, anything over 100% is generally considered to be a business is highly geared. It has some level of risk, and it's got high gearing and low solvency, and future long-term stability. It should be said also, though, that like the liquidity ratio, for a business that has a high current ratio, they can be criticised because they're not effectively deploying cash and they're holding on to too much cash. And the same is said for gearing. But if businesses are lowly geared, then they, while they might get criticised, they may well get criticised because they're not being aggressive enough in trying to grow that business. So that is why it's imperative that gearing ratios are compared from one business to the next in similar industries over time periods and against industry averages, because in some industries it may well be appropriate to be relatively highly geared, whereas in other industries, more conservative industries, that may not be the case. So that's it for gearing, and in the next video we'll look at the key profitability ratios.